The broadcast is now starting. All attendees are in listen-only mode.
Well, good morning. It is the 3rd of April. It's still morning here in the UK. It's, of course, afternoon now in South Africa. So good afternoon to everybody at home who's having a look with some concern at what's been going on the stock markets in the last little while. Just to show you that I am in person. There we go. Hi, I'm Alec Hogg. I'm coming to you from London, from our offices, the BizNews offices here at WeWork, which is on the south bank of the Thames. The weather getting a little bit better. I've just got back from South Africa, so as you can see, nice color in the face. Anyway, we've got different kinds of colors, I think, in people's faces when you start having a look at what happened in the portfolio. A lot to talk about today, and I'm going to try and show you a video as well. So we'll be giving you lots of interesting information in the next hour. But first up, before we go there, in Johannesburg, our managing editor, Stuart Lohman. Stuart?
Thanks, Alec. Always good to be here for another update. I know, as you mentioned, probably not the easiest update for us, but we'll see how it goes. Just quickly, before we get started, can I just see a show of hands if people can hear us, please, just so we've got all the technicals in place. Okay, that's excellent. We've got a whole bunch of hands there. Thank you very much. And just as we go through, we obviously like to keep it conversational. There's little questions drop-down menu on the control panel on the right-hand side there. If you can just drop them in there, and I'll get them through to Alec as we go through as he goes through the portfolio. We keep it conversational, so it's not sort of a big rush at the end with all these questions. But I think that's it from my side. Alex, thanks very much.
Brilliant. Well, we've got some changes to the portfolio as well. Those of you who've been following the global share portfolio for some time will know that I've been nervous about a couple of stocks. Unfortunately, we didn't move quickly enough. But anyway, we now have the definite decisions to offload 2 stocks in the portfolio and to bring in Alibaba, who I've been talking about for quite some time. So let's get into that to begin with. Goodbye, Facebook. The reason for this is, well, it's pretty evident. Facebook has got itself involved in a massive scandal over Cambridge Analytica. And I'm going to try now to show you a video from the Wall Street Journal, which to me shows things so much better than, well, it certainly is the best explanation that I've seen so far of the whole Facebook story. And let's give it a crack. If it works, great. If it doesn't work, oh, by the way, just watch out for the lip syncing. It looks in some respects like an old Hong Kong movie. So please don't worry too much about that. But let's have a listen. It's only 3 minutes, but it really gives the background to the whole Facebook story.
Facebook and its CEO, Mark Zuckerberg, are under a ton of pressure right now. So much pressure that Zuckerberg nervously sat down with CNN to say this.
I think what's clear is that in 2016, we were not as on top of a number of issues as we should have, whether it was Russian interference or fake news.
The latest issue? Facebook admitted that a developer who had accessed the data of 50 million Facebook users later sold it to a political firm called Cambridge Analytica. That firm was later hired by the Trump campaign. Facebook says both parties violated its policies, but many users feel the company could have done more to protect their data, and a growing number of people say they're leaving the site. So this is 2018, but to understand what's happening today, you have to look back to Facebook's policies between 2007 and 2015. In 2007, Facebook opened its platform to developers, meaning it allowed outside apps to access all kinds of user data. Did you ever play the game Farmville? Or did you ever use Tinder or Spotify? You may have noticed that when you use these apps, they ask you to sign in through Facebook. Back then, Facebook allowed apps not just to access your information, but also to access the information of your friends, and that helped the apps and advertisers better understand your preferences. During this time, Facebook became a fixture in its users' lives. By allowing access to that data, Facebook paved the way for all kinds of apps to help people find dates, search for jobs, be productive, and stay entertained. It also ushered in a new style of political campaigning.
The new Obama 2012 smartphone app has everything you need to get the president's back wherever you go.
And that, in turn, fueled the social network's growth. In 2007, Facebook had 58 million users. Today, it has more than 2 billion. But back to that period we were talking about. In 2014, Facebook dialed way back on its data sharing policies. It announced that it would restrict the data that apps could access, and it would stop allowing developers from getting the information of your friends without their consent. Those changes were implemented in 2015. But this period in Facebook's history had already opened the company up to some of the massive problems it's facing today.
If you pass on that amount of information to somebody who's trying to manipulate you politically, then of course they're able to exploit your vulnerabilities and send you customized messages that no one else will see, and no one knows what those messages are.
In 2013, when all of this data was still available, a Cambridge University researcher accessed the information of 50 million Facebook users. That data was ultimately sold against Facebook's policies to Cambridge Analytica. Cambridge Analytica says it's launching its own investigation to determine if the firm engaged in any wrongdoing. Now, Facebook says it's investigating all of the apps that had access to massive amounts of user information. But that's a lot of apps, a lot of Facebook users, and a lot of their friends.
Well, it's hard to know what we'll find, but we're going to review thousands of apps.
Well, thanks, Shelby. I'm sure that is something that perhaps puts everything into context for you. Now I just have to get out of this stuff. My apologies. By putting that into context, we now have a pretty good understanding, I guess, of what went on. I'm going to get back into the main presentation now. Very glad that the technicals worked as well as they did. And there we go. Right, Stuart, just to make 100% sure, I know the lip syncing wasn't great, but outside of that, did you see the presentation? And can you see now that that we're back with our webinar on the screen?
Thanks, Alec. Yeah, audio was great, and the graphics came through well, so thanks for that. Just on the presentation, it's not full screen, Alec. Other than that, it's there. It's just the full portfolio. You know, it's the PowerPoint box around it.
Okay, let's give that another little tweak, and hopefully
perfect.
That'll sort it out. Is it looking better now?
100%. Thanks, Alec.
Fabulous. That was a very good video because it unpacks for me exactly what was going on. Now, I've been following this Cambridge Analytica story since it broke on the 19th of March. And since the 19th of March, the share price of Facebook has been tumbling. It has gone down. Let's have a look at the next trade, and then you can see it quite clearly. Facebook's stock has broken below that simple moving average line. We just use it's just a 15-day moving average line decisively, but not. It hasn't plunged yet. The view that I have here on Facebook is that this is the beginning of a scandal that could continue for quite some time. At the best, it's going to put a cap on the Facebook share price at very best. And in fact, at worst, it could bring a lot more problems for this company. We bought, as you can see the arrow there, we bought at below $125 a share. Remember, the strategy that we have is to buy over a 3-month period, 1/3 in month 1, 1/3 in month 2, 1/3 in month 3. And over that period, when we acquired the Facebook shares, they are still, well, in US dollar terms, it was still a profit of 25% on where we've sold out. In Rand terms, the profit is a lot more modest because the Rand is appreciated over that period. But it's pretty clear to me, and it should be to you as well, that this is a developing scandal. Mark Zuckerberg, who's a shy geek, is not best positioned to speak in public. He is now being called in front of Congress in the United States, and that's a little bit of a lottery because one doesn't know how he's going to come across there, and indeed whether he's going to give the Facebook faithful an upliftment or if it's going to go the other way around. In essence, what happened, as we saw in that video from the Wall Street Journal, is that the Facebook apps between 2007 and 2014, during that period when it had this massive explosive growth from 58 million users to over 1 billion, well over 1 billion users, what they did then was open up the platform to app producers. People put apps together like, or for instance, as they made the example, Farmville or Tinder rather, which is a dating app, or Spotify, which is something that I use. And they encourage you to sign in via Facebook. Once you signed in via Facebook, it gave the developer of the app access to all of the data that you have. It's your personal emails, it's your personal messages, but everything else on your status, everything that you publish there. But worse than that, it also opened access to all of the people who you had befriended on Facebook. So if somebody asks me to be a friend on my private account, I generally say, yes, I've got you 5,000 on the private account now, so I can't really get any more people there. But I don't know most of these people. Had I done that, had I signed in to Spotify, the music app, via the Facebook login, what would have happened is that all of those people, of those 5,000 people, would have had their data in the same way as my data being accessible by the person who put together the app. Cambridge Analytica, who are a political drive, a political business, a business that was hired by the Trump campaign, used that data to produce fake news, blogs, etc., into the audience to get the votes swung, and indeed it did the same thing in the UK for the UK election of Brexit. So now we kind of know how Trump got into power and how Brexit happened, despite the odds being heavily against them. And there have been a lot of people who've been warning about this stuff now that it's come out into the open due to a whistleblower, Mr. Wiley, who actually was the co-founder of Cambridge Analytica. As a consequence of that, we now know the story. My sense of this, Facebook has got a scandal. Warren Buffett's advice, when a company is tinged by a scandal, run for the hills. You might have seen that on the other portfolio, on the JSE portfolio that we run, we also, when Steinhoff, which was a very small holding, thankfully, the smallest holding in the portfolio, when that was tinged by scandal, we got out. We sold everything, well, after investigating on day one. In day two, we sold out completely. And that was a consequence. We sold out at 6 Rand a share. The share price then went up a little higher. But as you see today, it's a lot lower than the level at which we sold out. And I've got a feeling that Facebook might have a similar situation as well. Anyway, if it's scandal, scandals tend to always go worse than you anticipate. And there's very rarely only one cockroach in the kitchen. Moving on to the second stock that we've sold out, and you will know there's been nervousness about Tesla for some time. Elon Musk is really not doing his stock, did his stock absolutely no good over the Easter weekend, when on the 1st of April, April Fool's Day, he published a picture of himself next to a Model S. It's that car that you're looking at, fast asleep, and under it, it had the sarcastic term bankrupt, B-A-N-K-W-P-T. Well, the trouble is that this went down like a lead balloon, and has been going down like a lead balloon with investors, as you can see from the share price there of Tesla, which has tanked since, well, in the last little while. You can see it since March, when it was at $350. Mid-March, in the last couple of weeks. It's now down to $250, and who knows where it could be going from here. I say that because the bonds that Tesla issued in August, where it raised a lot of money the first time it went into the bond market, are now trading at 87 cents in the dollar. What that means is that if you buy the bonds today, you are getting them at a discount of 13 cents in the dollar, just on the basis that it will at some point in time actually pay back the money that it borrowed, and it's at a yield of 7.6%, which in the United States is very, very high. Also, Moody's cut the rating. We know all about credit ratings. Those are from South Africa. It cut the rating on Tesla to CAA1, which means poor quality and high risk of credit default. So lots of concerns going on there. The problem for Tesla, and we've been talking about this for a while, is that the investment analysts have been extremely negative on the company. It is the biggest short position on the New York Stock Exchange, even though it's far from being the biggest company. It is a business that's done amazing work in the electric cars, but it now looks more and more like Elon Musk might have taken on too much. He did predict, or had been promising too much. He did promise that they would be building hundreds of thousands of the new Model 3. And the problem is the Model 3, which is a car that'll be sold at $35,000 a pop. So for an electric car, a very low end. The problem there is that the manufacturing issues have bedeviled them. They've never got anywhere near to the promises that he made on production. And over the weekend, again, Musk confirmed that he has personally taken over the manufacturing responsibility. Now, if you have a look at it, it can tell you two things. One, that there are big problems in Model 3, and secondly, that Elon Musk has maybe got too much on his own plate. So my view on this one, just finally on evaluation, even now, Tesla's market capitalization, in other words, the total value of the company, is only 15% below that of General Motors. General Motors sold 100 times more cars than Tesla last year. It made a profit of $10 billion. Tesla lost $2 billion last year. I think Elon Musk is a genius. He's a wonderful entrepreneur. But at this point in time, this stock remains very, very high risk. And as a consequence, we would rather just stay on the sidelines and depart from our investment here. Again, the good news is that in US dollar terms, we invested, as you can see there from the arrow, in the 3 months period, we bought into the stock at under $200 a share, and we're now exiting at $250. Of course, it would have been much better to exit at $350, but that wasn't the case, and we are now terminating that in our portfolio. I know there've been a lot of questions in the past about Tesla in particular. Facebook's troubles came from left field, and that's one of those things that when you get tinged with that kind of scandal, you really need to understand more about it before you take a decision. But on Tesla's side, it is now, I've been nervous for a little while, as those of you who've been on the webinar every month will attest, but now it's that nervousness has turned into action. Stu?
Thanks, Eric. No questions on those two. There's a question on Amazon. Do you want me to throw it at you now, or do you want to pick it up when you go through the stock?
I think let's pick it up in a little while, and the reason for that is because we are going to be just going through the portfolio quickly, and then the first stock we'll talk about is Amazon. This is the portfolio pre the sale of Facebook and Tesla. So in other words, we sold them today. Well, the US market was was open on Good Friday and on Easter Monday. So we're out of those stocks now at the share prices that are shown, and that is, I'll give you a little bit more detail on that. But the important thing is you have to look at it down the bottom. The portfolio in dollars is now $329,000. That is a decline of $40,000 or 10% from a month ago. So at the very peak of the market, which was a month ago, this portfolio was worth $369,000 US. It's now worth $40,000 less. Against that, the rand has depreciated against the US dollar about 2% in the past month. So that's stabilized things a little bit for the South African investors. And of course, we have the good fortune of having invested in some pretty useful stocks in the past. But what is interesting here is if you have a look at the Vanguard, which is the market as a whole, the Vanguard S&P 500 index is up 25% since we bought in, nearly 3.5 years ago in December 2014. And you can see that we still have a nice weighting there of Amazon, Alphabet, Apple, and Tencent, which have done better. Even Facebook has done the same in US dollar terms from our purchase price for the overall market. Underperforming the overall market, Microsoft, Metro Bank, which has been a disappointment, but I'm hanging in there. Berkshire Hathaway has done better than the market generally, and so has Tesla. So generally speaking, the only real concern or disappointment over this period has been Metro Bank, and there's a reason for that too. Interesting developments in that stock. But this is pre the sale of Facebook and Tesla, and in comes Alibaba. Now, it must be 6 months that I've been talking about how much I like Alibaba. It has, however, as you can see there, since it was listed in September 2014, it would have been a good time to buy the shares. Alibaba did not a whole lot for 2 years, and then started running in September towards the end of 2016, when it came from just under $100 a share, which is pretty much where it listed, and pushed up to over $200 a share. That looked a bit rich in 2 years. It's now come back to $177, and that's the level that we bought into Alibaba on. Why Alibaba? Well, the big three internet stocks in China, or the big three internet players in China, Alibaba, Tencent, and Baidu, are all undervalued relative to their American peers. So if you believe the story of the fourth industrial revolution and you are invested in an exponential portfolio, which is what I am, I really believe the story. I understand, I think, most of what's going on in that field, having spent 20 years in the digital market, digital publishing market. It does give me a lot of confidence to be investing in Alibaba. And the way that Alibaba and Tencent have operated, remember Tencent's also in our portfolio, means that they are not really vulnerable to the decisions by Donald Trump, which may or may not be a negotiating stance. Who knows with this guy? Nobody seems to be able to call him. But what we do know, as far as Donald Trump is concerned, is that soon after he got into office, he was talking trade war with China. He's now moved along that path. Is it a negotiating stance or not? One cannot be totally sure. But what he has done is he announced tariffs on steel and aluminium, 25% on steel, 10% on aluminium, which was targeting China. There has been behind the scenes discussions in China. China retaliated yesterday with its own tariffs, and they have been described as a measured response. There was a 25% tariff on pork, 15% tariff on fruit, but it is a start. It only affects $3 billion US. Now, it's a lot of money for a country like South Africa, but when you're talking about these big giants, America and China, it really is playing on the margin. So at the moment, lots of negotiations going on. If you want to understand a little bit more about Donald Trump's way of doing things, there are many books about his negotiating strategy, but probably the best of them is the book that he wrote himself. And in that book, Trump explained to us that he likes to push the limits, and eventually he says he gets what he wants. So whether the risks when you're doing it on behalf of a whole nation are adequately compensated for, only time will tell. But at the moment, Trump is certainly trying to negotiate his way to a better trade deal against China. It's not going to affect Alibaba. It doesn't have a significant exposure in the United States. Alibaba is primarily a Chinese company, and in China itself, it is growing like Topsy and has the full support of the government. And there, President Xi has just confirmed his own position of power by getting the Communist Party to vote him essentially as president for life. Well, if he wants to continue in that role. So it's an interesting contrast between what is happening with the American tech stocks and what is happening to the Chinese tech stocks. First of all, the Chinese tech stocks, Alibaba and Tencent, which we have in the portfolio, are very well insulated from Donald Trump, and they are also very well focused within the Chinese economy, which continues to grow, and they are also expanding their footprint into more populous parts of the world. They would, I suppose, at some stage like to get involved in the United States, but at the moment they've got enough on their plate. The story with Alibaba, though, is a long-term one, and I'm very happy that we've got that now finally in our portfolio. The changes to the portfolio, then here they are. Cash holdings, we started off with only $500 in cash, and then there was a small dividend that came from the S&P 500 index. They pay quarterly dividends. Then the sales, we sold out completely in Tesla and completely out of Facebook. There's the Rand profit. During this period, the Rand, in fact, since we bought into both of those stocks, the Rand has appreciated strongly. I'll show you that in a moment. But still, we made a profit on both of them in Rand terms. That takes the cash brought forward to nearly $40,000. And we have triggered our one-third purchase. Alibaba is going to be a big stock in our portfolio. And the first third has been purchased at $177 a share, which leaves us with a bit of cash. So next month, we'll be buying more in a perverse way. We'd actually like to see the Alibaba share price fall between now and then. And here's the portfolio in dollars now, when you have a look at it as a consequence of the sale of Facebook and Tesla and the purchase of the Alibaba group, which at the moment only has 4% of the portfolio, but we're looking to take that up to at least the same level as Tencent Holdings, to give us that Chinese or bigger stake in the Chinese market. Interesting to look at the performances of the individual stocks. Amazon, by far, our star performer, and there's Alphabet as well. In the last month, Amazon has fallen from $15.22 to, as you can see there, $13.72. That's taken $8,000 off the value of the portfolio. Alphabet has also lost $8,000. And of the rest, Tesla lost $6,000, even though it was a small holding. Of the rest, Facebook lost us $5,000. So I guess we're getting rid of the two, outside of the two big holdings, which between them in this portfolio have well over a third invested in them. We're getting rid of the two dogs who were impacted by special circumstances in this quarter, and then retaining the stakes and everything else, and of course increasing the holding in or starting a new holding in Alibaba.com. There it is in rands. The portfolio, as you can see, the rand weakened a little against the US dollar in the last month, and why it looks a little strange. We've got 27th of February to the 3rd of April. We did not have our normal end of March webinar. This is the end of March webinar. We'll have one at the end of April as well. Reason for that is my travels. I was in South Africa on compassionate leave. Then the decline, as you can see in the rand against the pound, has helped a little bit with the Metro Bank share price, and the rand against, sorry, the bottom thing should be Hong Kong dollars. That was a very small change. The annualized return of the portfolio is now getting more into normalized level, although 26% over 3.5 years is an excellent annualized return. But that's bringing it down to a more realistic area of improvement. Remember, we've been running at over 30% for some years. 26%, it takes the pressure off all of us. It is a fantastic return in anybody's language. Just to quickly bring you up to date on the movement of the currencies, you can see that the rand has appreciated strongly since Cyril Ramaphosa's appointment. In fact, just before Ramaphosa was appointed as president of the ANC, or voted in as president of the ANC, it's a 20% gain, and it seems to now be quite comfortable at below 12 to the US dollar. It's not just against the US dollar. There's a similar improvement in the rand from the same time against the British pound, now in midway between 16 and 17. And there's the Hong Kong dollar. As you can see, that's replicating, because it's closely pegged against the US dollar, and it's replicating what happened with the US dollar. And then the individual performances of the stocks, this is very clear who our top performers have been in rands: Amazon, Alphabet, and Berkshire. Nice to see Berkshire outperforming the market. Below the market generally is Apple, Tencent, and that's because of the different purchase periods, different times that they were bought. Both of those stocks were bought when the rand was particularly weak. Tesla, as you can see, 9%, Facebook 7%, and then Microsoft and Metro Bank, but all of them at least on the right side of the zero line. And there you can see graphical representation. So Amazon.com is our favorite stock, and not surprisingly. Stu, shall we pick up on that question now?
Thanks, Alec. Yeah, it's from Evan Kruger. You mentioned Trump's remarks and tweets. Obviously, they had a big focus on Amazon in the past month. He said, should we be worried about his comments, or if not, is it not a good time to buy the stock?
Yeah, Evan, it's a good call. Donald Trump is he's the kind of person who can cause a lot of damage. I just want to take you back to my horse racing days, and I love this analogy, this metaphor. It works quite well. When you had a really good racehorse, a bad trainer was unlikely to be able to stop it. But if you had a mediocre racehorse, a bad trainer was never going to get that racehorse to fulfill anything more, any of its potential. But great racehorses perform anyway. And that's pretty much what we have here with Amazon. It's a great racehorse. It's a fantastic business model. It's the consumer's friend. Amazon is transforming retailing around the world to the advantage of the real stakeholders, which are the people who are purchasing. the goods. When you're buying, if you want to buy anything in a first world country now, particularly in the US and the UK where I'm based, you will get a much better deal, a much greater choice by buying through Amazon. It can't be a bad thing when the consumers are on your side. Donald Trump, on the other hand, has been nailed by Jeff Bezos's newspaper, The Washington Post. Bezos bought The Washington Post for $250 million, which is a snip if you consider what it was worth many, many years before. But he bought it to try and implement his ideas on how the news media would change, and I think also to give himself a mouthpiece in Washington. This is Trump's obsessed about the Washington Post, and he is by definition similarly obsessed about Jeff Bezos. So just put that on the back burner. That's where this whole thing is coming from. Trump tweets things about Bezos wherever he feels particularly aggravated about it, and he tweeted yesterday that Amazon is only in business because it's relying on the US Post Office, which is losing money. So were it not for the US Post Office, Amazon would not be around. Well, and that's complete bunk. The statistics of the distribution tell you that. In the UK as well, Amazon has a very good business, and some of it is delivered by Royal Mail, which, by the way, is privatized. But most of it is delivered by couriers. They have Amazon Prime, which takes care of, and there are tens of millions of people who've signed up for that subscription service. Donald Trump is the kind of person who doesn't read, he doesn't understand, doesn't get into the details of it, but he gets influenced by the superficiality of whatever might have been told to him that day. And that's why you can see that he has had such problems in having thoughtful people around him stay with him. So let's just go back to what Warren Buffett, and remember, this is a portfolio where we use so many of the Buffett ideas in it. And you go back to what he would say about this, and he said at the annual general meeting of Berkshire Hathaway last year that America has survived worst presidents in the past. It will survive Donald Trump. And I would say the same thing for Amazon.com. It will survive Donald Trump, no matter what he is, or how he might be railing against it. He does, however, because he has such a powerful position, have the ability, like a bad racehorse trainer, to cause problems for this company. But eventually, it will come into its own. That's my personal feeling. Trump is showing that he is not good for America, and increasingly, even his supporters are understanding that that is the case. Does it mean that this unguided missile will be brought to bear? Who knows? There are many checks and balances in the US system, and South Africa survived Jacob Zuma, who is a Trump-type character. Should we be believing that America would not survive Donald Trump, well, then pretty much everything that all the good sense that Warren Buffett has been telling us would be out the window. If you don't own Amazon shares right now at 13.72, you could be putting in a buying program. But I would urge you to do it in the same way as we purchase shares for this portfolio, 1/3, 1/3, 1/3. So you would buy, if you had $10,000 that you'd like to invest in Amazon, buy $3,300 worth now. In a month's time, buy $3,300, and a month thereafter, $3,300. The economics of this company remain absolutely sound and exactly as they always have been, despite the fact that they've got someone in the White House who has a personal vendetta against the CEO of the company.
Excellent, thanks, Alec. Just a comment from Steve, or more a request. He says, would it be possible to include annualized returns in some of the charts now that there's a considerable time difference between some of the investments? So stock specific, I think he's asking for.
Annualized returns in the charts?
Yeah, so stock specific annualized returns.
You know, I get it, but I'm going to try to avoid that. And the reason I'm going to try to avoid that is because when you buy these shares, you should be buying them forever. So you could be buying them at the wrong time, relatively speaking. But generally, what I'm trying to do with this portfolio is I'm trying to find stocks that you could own forever. I really believed you could own Facebook forever. And until Cambridge Analytica, it with the margins that Facebook was generating, with the business model that it had, with the way that it appeared to be idealistically based towards supporting its users, all of these things to me, from what I'd seen in Davos of the Facebook people, it did seem to me as though we had a company there that we could have in the portfolio forever. What's bothering me about it now is that they clearly have got a scandal which has has to change your opinion about Facebook. However, and similarly with Tesla, we've been waving flags about Tesla. We've given Elon Musk the benefit of the doubt. We've had the South African sense of it. We bought them at $200 and under $200 a share, so it gave us that buffer as well. But now, I even though you cannot but help to admire Musk, the entrepreneur, what's happened recently at Tesla has to give you pause for thought. So if you were now starting to do things on an annualized return, or even like hedge funds do every month, what's happened to the portfolio, that kind of defeats the object for me, because here what we're saying is you buy the shares, you put them away, you do your homework first, you don't worry about what happens every month or what happens in the short term, unless there's a very good reason for it to worry. And in both Tesla and Facebook's case, and we've had the similar thing in the past with IBM and Novo Nordisk, we have changed when the facts change, as John Maynard Keynes said, you need to change your thoughts on it. So it's a good idea. You can do it as well. I mean, these portfolios, every webinar is there going back to the beginning. It's all on the Biz News Premium section, so you can go through each of them and zip through them if you want to see exactly where we are and what the daily and the monthly returns are. But I would like to stay away from that. This is not we're not in the hedge fund game here. This is a portfolio for you to replicate through Standard Bank's web trader facility, and every month come back here. And if you don't like my rationale and my reasons why I'm still sticking with some of the stocks, and in certain cases, if you hadn't liked, I know an old school friend of mine was giving me a little bit of a rev for some time now about Tesla. I hope she sold her Tesla shares, because that was the way she believed or she felt on it. That's really what this is all about. So nice idea, but I'm not going there. I hope you understand.
Thanks, Alec. No questions at the moment.
Right, so let's carry on with the portfolio, because as I said, there's quite a lot of stuff that happens. There's Amazon's share price. Interestingly enough, it has fallen, but it hasn't fallen like, or to the degree that percentage-wise that Alphabet has gone. Well, that had a big hit yesterday, 5% smack yesterday, because of what Donald Trump tweeted. And so I guess there are people now getting nervous, and the whole market as a whole is in a nervous state. So as a consequence, Amazon is now being impacted by this. But it's a very, very different share. Amazon and Apple are very, very different stocks to Alphabet and Facebook, for instance. And we saw that. I'll mention that in a moment when we talk about Apple. And similarly, Amazon is a retailer. Its fight is against Walmart and the other retailers and every new area that it goes into. Its fight is not against other tech stocks or people who can make tech more difficult. So we haven't seen a decline like this. We saw that decline. You can see it quite clearly there in February when the market came down. But that did not impact or nothing like the decline that we've seen now. However, we're still above where we were at the worst point in February, which is quite interesting. So I'm not worrying. The share price can carry on, can keep falling to $1,000. I'd still be quite comfortable. And indeed, if you look back over the whole of last year at $1,000 a share, it is a stock that would be very, very attractive. But technical analysts will tell you that as it's broken below just use a very simple moving average. It's now on the way down. And let's see where it bottoms or where it comes out. So if you're going to buy, or if you're tempted to buy now and acquire a stake in the company, if you've been too scared in the past because you were worried about the valuations, well, just buy it over the next 3 months. I think in the long term you won't be dissatisfied. One last point about Amazon. It was around one of the few tech stocks that was around in the late 90s when we had that surge in NASDAQ and the blow off in January 2000. if you had bought Amazon shares at the very, very peak before the blow-off, and remember it lost more than 90% of its value in the blow-off. If you'd bought Amazon shares at its very, very peak of the dot-com boom, you would have made 10 times your money today. So in 18 years, you would have had a 10-bagger. If you'd bought it after it dropped 90%, well, I mean, the numbers are just mind-blowing. In other words, if you'd bought it after the bust of the dot-com thing, but even if you bought it at the very, very top of that dot-com bubble, and that's what I'm trying to get at with this portfolio, and that's what Warren Buffett teaches us about investing. Moving on to Alphabet. Alphabet has had a wild ride, as you can see this year. And that's the big story indeed about what's happening in the US stock market, is the volatility has returned. For a lot of last year, those people who were long on volatility were losing a fortune because the markets were very unvolatile. The consequence of that, of course, was that the exchange-traded funds way outperformed the active managers, because when you're an active manager, the Alan Greys, the Coronations, Investex in the South African parlance, you're looking for stocks that are going to outperform the market generally. But if there's low volatility, it's very difficult to get those. However, when the volatility is high, then the stock picking becomes critically important. And this is where the men and the boys will be separated as far as the active managers are concerned. And you will see the active managers, the good ones, now starting to outperform the indexes in the United States or in the global portfolios. The bad ones are going to heavily underperform the index because volatility makes amplifies your successes and your mistakes. So it's again, if you just want to go with an exchange traded fund, fine. There's nothing wrong with that. You'll get the average, and it's certainly not going to end up by getting hammered by having some really bad fund managers. But on the other hand, to go with the great stock pickers who have consistent records over many years, you're going to outperform exchange traded funds again. So the good active share managers are loving the increase in volatility. You can there see what happened with Amazon. Again, it's a little bit of a knock-on effect there from Facebook, because Amazon has, like Facebook, been selling advertising or data to advertisers. So what they do on Alphabet, which owns Google, what Google does is it accumulates a lot of data about us when we use its search engine. We don't pay for that facility. And it takes that data and it sells it on effectively to advertisers. So advertisers want to reach a particular market. It will buy that market from Google and from Facebook. And as a consequence, between the two of them, they have 80% of the online advertising market. They are simply way ahead of what the competitors can offer. The problem, of course, as you're seeing in the share price, is that data really theirs? Should they be able to harvest it in the way that they've been doing? And are the authorities going to squeeze them so that they can, with privacy policies, which no longer makes this possible? Alphabet's share price, as you can see, has had that knock-on effect from Facebook. I'm not too worried about that because they do have various other impacts. Alphabet hasn't got a scandal of the Facebook type at the moment. If something were to break there, you would know that you'd have to have a reassessment if they had a similar Cambridge Analytica type scandal. But Alphabet has always had the basis that we do no evil, whereas what we saw from Facebook was the leaked memo that recently came out, which said we grow at all costs. So no matter what it costs us, or no matter what we get ourselves into, like Facebook has got problems with the Russians who manipulated Facebook apparently for Donald Trump's benefit, and had fake news, as you saw in that Wall Street Journal clip a little bit earlier, that Zuckerberg admits in 2016 that they didn't have a finger on those pulses. There's been nothing like that coming out of Google. So as a consequence, I'm still quite happy to be with Google. Apple's chief executive, Tim Cook, has been very quickly out of the starting blocks to say we are not the same as Facebook. We do not harvest data, user data, and then sell that on to advertisers. We are a company that sells products, and we have an ecosystem within which those products can then get used most efficiently. And also, because of the ecosystem, we can keep out viruses, etc. Apple supporters, and I'm one of the biggest, ever since buying an Apple IIe, and one of the thrills that I had in my journalistic career was meeting the man who created the Apple IIe, Steve Wozniak, because it transformed my thinking in journalism. I could become a freelance and write through this computer rather than having to write on a typewriter. That Apple IIe, going back 30 years, Apple products have been my products of choice. And within the whole ecosystem of Apple, it'll be very difficult for me right now to move to an Android or to anything outside of that system. And there are over 1 billion devices that Apple has in the marketplace. So when Tim Cook, the chief executive, says that we are not Facebook, we are not Google, we are a company that sells devices and then has those devices engaging through a system, you have to understand that he's telling the truth, even though Mark Zuckerberg says clearly, as you would expect him to, that he does not believe that Tim Cook is 100% accurate. Cook has called for greater regulation of data and privacy, particularly as a barb towards Facebook and Google. And he says that there are certain tech companies, mentioned those two, which have failed to self-regulate in this field. Interesting story. Apple, very happy to be invested there. And if you haven't bought into it yet, the recent knock could be giving you a good buying opportunity. Remember, it is the second largest stock in Warren Buffett's portfolio. Moving on to Tencent Holdings. Pony Ma's star rises and rises, but his share price doesn't always do that. And this is an interesting story made in South Africa. If you see the decline in the Tencent Holdings share price, it was directly attributable to the decision by Naspers to sell, 2%, 1/15 of its shareholding in Tencent. It was very public about it. It's got other investments around the world. It wanted to raise money from selling 2 percentage points, or 2% of the 34 or 33 rather that it held in Tencent Holdings. It's now down to 31% in Tencent. It wanted to sell that to raise about $10 billion and use that 10 billion to invest in its other activities, of which they are substantial. We've covered that in some detail in the past. But the news that Naspers was selling some of its holding was not well taken. A view was that if Naspers was wanting to get out of any of its shares, you have to believe that the Tencent shares are not cheap anymore. And as a consequence, it's come down from around $450 to $400. That's in Hong Kong dollar terms. Generally speaking, though, that's got to be something that would, again, trigger some kind of a buying opportunity. Tencent and Alibaba, both being Chinese-focused businesses who are not vulnerable to either the derating, because they're not as their rating is a lot lower than that of the US companies, or Donald Trump's volatility. Vanguard S&P 500, this is the overall market, and you can see what it does is it weights the top 500 shares on the US stock market. It charges a tiny commission, 4 basis points, 0.04%, if you want to put it into those terms. And it gives you an indication of how the S&P 500 index has gone. And you can see there, after peaking at, when was that, just before the February knock, the S&P 500 index came down sharply in February, recovered its composure somewhat, and then this recent sell-off driven by Donald Trump's trade war talk, and is tweeting on some of the stocks there. So that gives you an indication of what's happening to the market generally in America. Microsoft is looking nicer and nicer. I'm very pleased that we've invested in it. It's been extremely resilient, as you can see there, to this tech sell-off. The share price is still around about $90 a share, and it's because the business model of Microsoft has been changed into a automated customers, or turning its customers from those who would go into stores and buy Microsoft products to now being automated. The monthly, I'm a subscriber to Microsoft 365. I think last night I downloaded something like a gig of updates to the system. That would have meant that I'd have been a gig out in the past, or had to try and find some updates somewhere else. It's now done automatically, and as a consequence of this, Microsoft's business model is very appealing, very exciting. They have those huge shares of the operating system through Microsoft Windows and through the office efficiency, or the efficiency and productivity tools like Excel, Word, PowerPoint, which you're looking at right now, and all of that. That's Microsoft Office 365 is available now to be purchased at a reasonable $9 or £9 on a monthly basis. So a really good stock for the long term, and remember, that's really what this is all about. Moving on to Metro Bank, that's me with the chairman, Vernon Hill, who, well, sold a few shares, and as a consequence of him selling a small number, £2.5 million worth of shares, the share price took a knock. Look at that. It dropped from £40 a share down to £35. On the view, I guess, that if the owner is selling some shares, well, maybe he believes that the share price has overdone it. It certainly, we did see that share price run up very significantly in March, early March, getting above £40 a share for the first time. Long term, though, I still like it very much. It's the Capitec of the UK market. If you believe the Capitec story, the growth story, although Capitec's growth has now come down to 18% a year, Metro is still growing at 60% a year. What's likely to happen here? At some point in time, somebody's going to take them out. You've got to believe that that's a possibility. Metro has now become, it's got a balance sheet which is very appealing. We saw recently that FirstRand from South Africa bought Aldermore, which is also, like Metro, it's classified as a challenger bank. Vernon Hill's track record was in building a bank like this in the United States, which was bought out. He started it from scratch. It was bought out for $7 billion US. He would clearly right now be a very appealing proposition already for one of the big banks in the UK. But that's not the language they're talking. They're still talking about expanding at a breakneck pace. So it's got two options here. The one is the Capitec option, and I bank with them, with Metro Bank, and I find them absolutely superb in every single respect. So I'm very happy there, and I think that it's one of those banks that will, in time, fulfill its potential. Very happy to be there. And Berkshire Hathaway, Warren Buffett's stock, you can see how resilient it's been. Hasn't done a huge amount in recent times, but it also hasn't been hammered in the same way as the tech stocks has. So it gives us a nice little ballast relative to the other stocks in the portfolio. Moving on to the final slide, which is our portfolio in Rand terms. There you have it, annualized return at 26%. The changes to the portfolio are quite significant when we've dropped Facebook and Tesla and brought in Alibaba. Alibaba's at 4% at the moment. Next month, it'll go up to 8%. We'll do another purchase of another, well, depending on what happens to the share price, could be 75 or so shares. There'll be a similar amount of money that'll be invested into it. And we are hopeful that in the long term, that'll be similar to the performance of Tencent. And there, just to remind you what the Rand has done since the beginning of this portfolio, the Rand has gone from 11.37 to 11.83. It's a 5% depreciation. And most of that is due to Cyril Ramaphosa, because up until the time of his election, the depreciation was substantially more than that. 25 to 30% was the depreciation over that period. The start of the portfolio came on the basis that we were very uncomfortable about the way that Zoomnomics was taking South Africa. Now we think that the rand is probably at a fully valued area, and in time, the inflationary differentials between South Africa and the United States, which is where most of this portfolio is housed, and also the productivity differences between the two, will see the rand easing back, not blowing out in the way that it did in the era of Zuma, but certainly it is a time to take advantage of what is, by historic terms, a pretty strong currency right now. Well, Stuart, that's kind of it. I mean, we've gone through the portfolio. If there are more questions, let's hit them.
Thanks, Alex. Just a couple questions. Paul Jeffries says, if you had lost money on Tesla as he has, would you cut your losses and use the proceeds for Alibaba?
Yes, definitely. The whole intention is not to look at where you bought in or where you sold out of. The intention is to see what is the valuation. Or with Tesla, what bothers me now is that reasons why we bought into the stock in the first place are no longer valid. So whether we bought them if we bought the shares at $350 and it's now at $250, those reasons are no longer valid, and that's the reason why we're selling out, not because we made a profit on it. And it's a mistake that one makes too often in investing. You have what are called stale bulls, who will be people who would have purchased the shares at a higher level than they're at today, and they're just waiting for the shares to get back to that level so that they can break even on that stock, and then they feel it's worthwhile selling out. Trouble is, once the shares get back to break even, they start believing, oh, the share price is going to go higher still, and they'll make a profit out of it, which sometimes doesn't occur. That's not the way to invest. The way to invest is to have a look and to remember you are a owner of the company. You own a slice of that company. Elon Musk worries me. He worries me because he's not paying attention to the realities of what's going on in the world. He might be right. He could be spectacularly successful, but the realities are that he has been unable to deliver on numerous promises. And at some point in time, the market is going to punish him for it. And the problem with his company is it's massively geared. It's making big losses. And he depends on investors funding it. If investors decide to stop funding it, he's got a problem. He made a joke about bankrupt or going bankrupt. That might not be a joke in the future if investors decide to stop funding it. And you can be sure that after the money that he raised on the bonds in August, now that those people who bought in at 100 cents in the dollar are now it's only worth 87 cents in the dollar, they're not going to be rushing back to support him or to give him more money next time he wants to borrow. Already those bonds are sitting at a yield of 7.6%. That's high in the US dollar, in the US market. And as you have more gearing and as you have more interest rate costs, that's killed many great entrepreneurs in the past. I'm not saying Tesla's going bankrupt, but what I am saying is that the risks are now really, really growing. So Tesla's not a stock for me to be holding anymore. And Alibaba, on the other hand, the risks are far lower. From what we know, from everything we know, the risks are a whole lot lower. And that would suggest to me that the long-term upside, I'll be very happy to have Alibaba in the portfolio. Don't get distracted by where Alibaba is sitting now or where Tesla is sitting now or what you might have bought in at or what you could have bought in at. If you'd done that, you'd have never bought Amazon shares. And you'd be a little disappointed about that.
Thanks, Alec. EJ just wants to know if you know why Apple has decided to drop the use of Intel chips.
No, I don't. And I saw that was breaking news. Unfortunately, it only came out in the last 24 hours. I haven't had a chance to research it. It's a very, very important question and a very important issue to look into. They've been together. In fact, I'm reading a great book, the follow-up or the book after Walter Isaacson wrote about Steve Jobs. He wrote a book called The Innovators. It was the next book. So clearly he'd done a lot of work on The Innovators. Then he had this opportunity to write about Steve Jobs and engage with Jobs, etc., and people who knew him. And then he came back to The Innovators and wrote that book. And I'm going back to the early days of Intel and Apple and how they've been joined at the hip in many respects, to now see that they are they're divorcing. It's an interesting decision. There must be a lot to it. So I will be doing my homework on that one, but I don't know at this point.
Thanks, Alec. A quick one before I think we need to log off. Benjamin wants to know, with your comments on the Tencent deal, what's your view on Naspers? I think it's more SA portfolio question. We just want to know, is it a hold, buy, or sell with regards to the Tencent sale?
I love Naspers. I absolutely love Naspers. I think that the stock is so undervalued. It's a little bit like Apple was for a long time. I remember when Apple was below $100 a share, it was almost as though investors were unable to get their heads around the market capitalization of Apple being at the level that it was then, because it was just so huge. And in a South African context, we have a similar story with Naspers. Naspers' story is not multi-choice, although multi-choice is a good business. It's multi-choice's scandal and whatever affected the Naspers share price. That's just crazy. Naspers' story is the investment in Tencent and the bets that it is laying elsewhere. And when you start analyzing those bets, it's gone big into classifieds. It's gone, or online classifieds, where it has a dominant position in many markets around the world. And it's gone big into delivery, into food delivery, which is, both of those areas are growth areas or rapid growth areas. And it's now got $10 billion from selling a small share of its holding in Tencent that it can use to expand those two operations and maybe balance its portfolio better. Remember, at the moment, you're buying Naspers at a discount to what its Tencent shares are worth. It's crazy. It's crazy value. So yes, I love Naspers. I think it's a kind of stock that you can put away and not worry about it. And please don't get distracted by the noise. It's a company that's making some very interesting investments. When you look back at the investments it's made outside of Tencent, Tencent has been a spectacular success, and it's very hard when you've got this gorilla that's just grown out of nothing, and you happen to be at the foresight or good fortune to own a third. In fact, it started off with 50%. Chris Becker and Antoine Brew bought 50% of Tencent for around $30 million. When was it? It was around 2000, around about that time, 99 or 2000. That has become worth, well, hundreds of billions of dollars. So it has been described as the greatest private equity investment ever. When you have that on the one side, what's the genius been? The genius of Naspers has been never to sell its Tencent shares. Any Tencent shares. It was diluted from 50 to 34 when Tencent was listed. It's now sold for the first time, but it's promised it won't sell another share for the next 3 years. So it's not selling the shares because it thinks Tencent's a bad company. It's selling the shares because it says it wants to raise some capital to put into other bets, which could grow, in its opinion, by more than Tencent would be growing. I just like it. I like the management team. I like the vision, and I like the track record. So yes, Naspers for me remains a buy.
Excellent. Thanks, okay. I see it drop below 3,000. It's not a very good level to buy, but thanks for that.
Indeed. Right. Well, that's it. We've come to the end of our program for today. Thank you for joining us. It's been a pleasure as always. And just to recap again, big knock for the portfolio in March. And we saw in the last month a decline from $369 to $329. Remember, we started at $200,000. So it's a 10%, call it just under 11% reverse, but it was a reverse that comes off a very high base. So that's really what investing's about. We have adjusted the portfolio in this month by ridding ourselves of Facebook and Tesla, both of those for very sound reasons. I hope you agree. And then we've brought in Alibaba, which we will be increasing the stake over the next 3 months. We'll be back again at the end of April. Until then, from Alicog, cheerio.